So you want to invest in real estate and you want to do so in a tax advantaged way. Well, you need to understand the opportunities to do so. Welcome into our series on short-term rental loopholes. So we are going to be deep diving through the short-term rental loophole and how that can be used effectively to generate massive tax savings and to potentially build an entire short-term rental portfolio that you can have as an asset to build your wealth. My name is Payton Gillis. I own and operate a boutique tax planning firm based in Lake St. Louis, Missouri called Tax Game Plan, and I also operate REI Tax University, which is a community that is meant to help real estate investors understand, utilize, and leverage the tax planning opportunities that come along with their real estate investments. So you want to invest in real estate and you want to do so in a tax advantaged way. Well, you need to understand the opportunities to do so, and one of them is the short-term rental loophole. You will also frequently hear this called the STR loophole. Now, in order to understand the STR loophole, here's how I break it down. There are several things that you need to understand, but we're going to break this into chunks, and going chunk by chunk, you will understand the full loophole and then how you can use it. The first thing you need to understand is two basic rules and principles about any kind of rental investment property. Rule number one is that rental investment properties often have the ability to cash flow and have economical income in real life for you. They have the ability to appreciate, but at the same time, they have the ability to create tax losses for you on paper. And rule number two about them that you need to understand is that those losses by default are considered passive losses. Real estate professional status, what's commonly called reps. So we'll quickly touch on that, but that's another big piece to this you want to understand. From there, you then want to make sure you understand basic depreciation and the basic concepts of depreciation and how that works. From there, you want to understand bonus depreciation. So you're going to understand basic depreciation in order to understand how bonus depreciation works on these things. And then finally, you're going to want to understand cost segregation studies, right? So if you hear of a cost segregation study, that's great, but if you don't know what depreciation is and bonus depreciation is, it's going to be very hard to understand what a cost segregation study is. So you want to understand these things and in that order. In this short video series on the short-term rental loophole, we are going to dive through all of these so that by the end of this video series, you will understand completely what the short-term rental loophole is, all these topics that we just talked about. You'll understand how you could potentially use it for you, and you'll have the resources available to you to do so. So let's dive more into the two principles about rental properties. They can cash flow, they can appreciate, and they can lose money on taxes, and they are passive by default. So how can they do this? Well, it's primarily due to depreciation, right? So depreciation is going to allow these rental properties to frequently have losses on paper, even though in the real world you are making money and you have cash flow. There are additional expenses that you can write off on these, such as mortgage interest, property taxes, insurance, certain personal expenses now that can be converted to business expenses based on the activities and how you're using them. So that's how, from the start, these rental properties can frequently generate losses, especially in early years. So next, you need to understand that any income or losses from these rentals is considered passive. They are passive activities by default. So if you have income, it's passive income. If you have losses, it's passive losses. This is important because there are specific rules to how those income and losses can match up. In general, passive losses can offset passive income. However, they cannot move over and offset active income. So if you have a $500,000 W-2 and you have a $100,000 loss from your rentals, in general, you cannot take that $100,000 loss and offset your $500,000 of W-2. If you have a second, third rental that are generating income of $50,000, $100,000, that $100,000 loss can offset those. If you have some other passive investment activities, it can offset the income from those. Other than that, it's going to get suspended. It's going to carry forward as a passive active loss that carries forward, or a passive activity loss that carries forward, and you are going to use it in a future year to offset other passive income. However, it's not going to move over and offset your active income. Now, there are some ways to do this, and that's what we will get into. So one of the primary ways that you can do this is by meeting real estate professional status, reps. So if you or your spouse meets this status, then you can take losses from your passive activities, like your rentals, and you can offset the income, the active income. So it could be from flips, it could be from your W-2, it could be from your active business. If you're filing a return as married filing joint, and one spouse meets reps, you can take any of the real estate losses from that, any of those losses related to the rental, and you can offset any of the active income, right? So that's how that can work. So if the husband has $500,000 of W-2 income and the wife is a real estate professional and they have $100,000 of passive losses from their rentals, they can match that up because she meets real estate professional status. So how do you meet reps? There are two main rules to meet reps. You must work at least 750 hours in qualified real estate activities, and those qualified real estate activities must be what you do with over half your time. What that means is if you have a full-time job that's not related to real estate, you almost could never qualify for this status. It is going to be extremely difficult because not only do you need to meet 750 hours in real estate, that's about 15 a week. I know a lot of people who do that on top of their full-time job, but you need to work over 40 hours a week in real estate. So if you work 2,080 hours in your normal W-2 job, you're going to need to work over 2,080 hours in those qualified real estate activities. And I'm going to give you a news flash. Even if you are doing that with a high-paying W-2 job, if you go under audit, if you go to tax court, they will not believe you. They're not going to believe that you work over 40 hours a week in real estate while you already work 40 or 40 plus hours in your normal day job. Now, the second thing to keep in mind from this is if you're a W-2 employee in qualified real estate activities, that time does not count unless you own over 5% of the company that you're working for. So if you're just working in a real estate acquisition type company or you're a realtor and you're under W-2, that time's not going to qualify towards your 750 hours. It's going to go against you towards your more than half your serviceable time, right? So those are some big things you need to understand because reps, if you meet it, you meet it, but a lot of people don't. It is very difficult. Someone's not going to go quit their $500,000 day job to meet this status, right? And maybe their spouse doesn't meet it or they don't want to work those 15 hours a week all year long to meet the 750 hours. So it can be challenging for a lot of people to meet it. When you do, great, keys unlocked. You can get rentals, you can offset income. You know, when someone comes in and it's like, hey, spouse one has high income, spouse two is a real estate professional, great, we've got the keys unlocked. We can go do all kinds of things from tax planning, but oftentimes that is hard to meet. So oftentimes when someone comes in like this, where they have that full-time W-2 job or they're not involved in qualified real estate activities, they're going to start to look elsewhere of what else can they do. And one of the top items they'll start to look at is something called the short-term rental loophole, the STR loophole. So this is written into the IRS tax code. When we use the term loophole, it is legal. A loophole is something where code's been written, the rules are there, the laws are there. They didn't really know that it was going to work like this, and someone figured out a way to make it work like this, and it's held up and it's legal and it goes by the rules, right? Someone found a loophole. It's not illegal, it's not anything crazy, but it's something that they didn't really intend to happen and someone figured out how to make it happen. That's the loophole. So the way the short-term rental loophole works is there is a section of the IRS tax code which says if the average stay at a property is 7 days or less at an investment property, then that does not fall into the passive loss rules and the passive activity rules. It becomes active. So it's a big deal because what that means is now you don't need to worry about reps anymore. So reps is completely gone if you're getting into short-term rentals. If the average stay on that investment property in the year is 7 days or less, then you're into the short-term rental world, which operates by a different set of rules. But there is a kicker for short-term rental properties, right? You don't have to meet those too hard reps rules. You don't have to do the 750 hours in more than half your time or your spouse do that, but you do need to materially participate. Now, these rules are much easier to meet. You only need to meet one of these potential rules. They are way easier to meet, and we will get into these in the video in this series. However, do know that it's not just, hey, I've got this and it's nothing. There is going to be some level of work involved to meet that material participation. So if you're someone that doesn't want any level of work with an investment, the short-term rental loophole is probably not for you, and we'll talk more about that later on as well. But now if we go back to our example where spouse one makes $500,000 and maybe spouse two doesn't meet real estate professional status, right? But they decide to buy a short-term rental, and that short-term rental creates losses of $100,000. As long as they materially participate, they can take that $100,000 loss, offset the $500,000 in W-2 income, so they're only paying tax on $400,000. Now, what this means for a lot of people is they go through the year on that W-2 job paying in taxes to the IRS and to the state as though they're making $500,000, and oftentimes it's a big significant refund at tax time because they now are only paying tax on $400,000 and they've already overpaid by $100,000. They've overpaid their, if they're at 35% tax rate, that's $35,000 that they've overpaid that they're going to get back now. So we've laid the framework here, and in these next follow-up videos, we're really going to talk about how you key in on this, how you materially participate, what that takes, what are those qualified activities to do so. We're going to talk about how you amplify and accelerate these losses, and then really how you put it all together with the tax savings, and then how you can build entire portfolios off of this to create wealth building opportunities. So be sure to continue watching here and learning more about the STR loophole.